All right. Welcome, everyone. We got a great crowd. Got about 40 of us on here right now and counting. So that's great. Thank you for taking the time to hop on this webinar. We really appreciate you coming out, and we're really excited to share this investment opportunity with you. The property is located in Jerome, which is in the Twin Falls MSA of Idaho. So this is a 506c investment offering for accredited investors. If you don't know, an accredited investor is someone who makes over $200,000 a year or has a $1 million net worth or more, not including your primary residence. So if you want to learn more, actually, Senate is going to be doing a webinar on this topic Thursday, April 4th, I believe. So if you want to check that out, go to his website or his socials and you can check that out. All right. This is not wanting to click forward. Oh, there we go. All right. So, as a disclaimer, we are not offering securities. We are not investment advisors, CPAs, or attorneys. So, please consult with those professionals and be sure to read the PPM before investing, just so you have all your bases covered. Okay. So, here's what we're going to cover today. We're going to talk about the overview and the details of the property. We're going to be going over the underwriting. We're going to be giving you everything you need to know to feel confident in making a decision if this is really the right investment for you. We want to make sure you have all your questions answered. So as we go through this presentation, please throw your questions in the chat or write them down on a notepad if you get a notepad. And we'll have a specific section at the end to answer all those for you. So what's so special about this property? Well, this property was built just recently and has all new appliances, so there should be no major repairs or CapEx, which is great for the profitability. The property has been 100% tenantized, and the tenants actually pay for all the electric, helping it be profitable starting day one of close. There will be lots of tax benefits, and we plan to raise rent by $250 per unit to increase the overall value of the property. So that'll be great for your profits as the investor. As you can see here, there are 7 fourplexes that make up this 28 unit property, all on one lot. So it's not divided up, it's all on one lot. And you can see the main entrance here to all of the fourplexes. And then you have one on the right, one on the left, and then up the stairs, one on the right, one on the left. And then the team. So I'm going to talk about the team and really the people that are going to be operating this investment. So Chris Carney has over 10 years of experience with property management and owns a property management company that actually manages over 350 doors within a 150-mile range. So this makes his addition to the team with asset management extremely vital. And his property management skills and experience really will help us optimize our returns and avoid having to pay much larger chunks of our profit to outside property management and other people. So, and lastly, he's currently invested in over 450 units across the country. So very talented, very skilled. And then Senate Eskridge is an experienced real estate investor who has successfully invested in 18 large apartment investments and currently owns over 800 units across the country. Not only is he a real estate coach, but he also hosts multiple real estate and business meetups and has more than 20 years of experience in the business. So 20 years of experience throughout business for development, management, sales, all further adding to his expertise as an operator. Both Chris and Senate actually call Twin Falls, the Twin Falls MSA home, and are heavily invested in the community there and the real estate. And then I'm Isaac Lewis. I've had years of experience in real estate, growing up as a second-generation real estate investor, currently involved in managing and operating a multi-million-dollar real estate portfolio. And I've had over 8 years of experience in the marketing industry solely related to real estate, including an investment company with over $450 million in development. So I'm also actively invested in real estate throughout Kentucky and Southern Idaho. Combined, this team really makes up a wealth of knowledge and experience to take down and successfully implement the business plan as we've done many times before. So now we're going to talk about the property overview, and I'm going to hand this off to Senate Eskridge to walk us through this.
Thanks, Isaac. Great job so far. I really appreciate all your help on this. So, you guys, there's a couple of things I really want to point out on this property overview. So, as Isaac mentioned, this is 28 units, a brand new build. So what that means is the residents who live there are the very first residents who have ever lived in this property, which is phenomenal because you don't have to worry now about maintenance issues, repairs, fixing appliances, or anything like that. It's also going to be profitable day one, which is a phenomenal thing. Most of these complexes take a few months to get up to speed. This one's going to be profitable right off the bat. You can see here, these are 3-bed, 2-bath units, every single one of them. Everyone's just over 1,300 square feet. I think it's 1,302 is the exact number. And the builder did an amazing job on these. They're very spacious. They've got huge bathrooms, a laundry room that you could, lay down in multiple different directions. Just absolutely wonderful places. My wife asks me every single time we do one of these deals, she said, is this a place that we could live? And absolutely, I wouldn't have any hesitation living in these units. The builder did an amazing job, which, by the way, he's on the call tonight. So we're very proud to have him here and a very good relationship with him. And he's been great to work with, done an amazing job. Last thing I want to point out here while you're looking at this picture, and we'll cover this in more detail in a few minutes, but you can see the top row where there's 3 buildings and then the 2 on the side kind of make an L there at the top. If you look just above that, there's this big kind of snowy field there. That is a brand new park that's getting built. I just wanted you to see in reference where that is, because I'll go over that in more detail in just a few minutes. So now let's jump over and talk about the investment summary and the details of this property. So we are offering a 6% preferred return on this investment, which what that means, if you guys don't understand that is, or use that before, is you as the investor get the first 6% of all the cash flow that comes out of this property. So now it's not a guarantee, but you're the first in line for any distributions. The next thing is it is only a $50,000 minimum investment. Most people are putting in around $100,000 so far, but you can get started for just as low as $50,000. And there is going to be a 50 to 75% return of capital at the end of the second year. Now, what that looks like is a refinance. So we're going to talk about the loan in a few minutes, but we're getting a loan with a local credit union. And then in 2 years, we're going to refinance that with probably an agency lender, Fannie Mae, Freddie Mac. And because we're able to increase the rents, as Isaac said, and we're going to be able to increase the net operating income, we're going to be able to return 50 to 75% of your investment back at that time that you can use for another investment or whatever you want, because it's basically a tax-free distribution to you because it's just a return of your capital, right? There's no taxable event at that point, but we still own the building. We're going to hold it another 5 years or so, and we're going to continue making. Now, over on the right, you can see we actually are purchasing this for $5.1 million. Now, we just got our appraisal back. You can see here it appraised for $5,480,000. So we're essentially buying $380,000 in equity day one. And again, that's credit to the builder because they did such an amazing job for us on that. And also because we don't have a realtor that we're paying, right? If we had to pay a realtor or a real estate agent, that $380,000 would all be eaten up by the commission. Since we're direct to the builder, you guys get that day one equity right off the bat. And depending on how you do the math, it's a 29% increase in value. Because of the 70-30 split, the investors are going to get approximately 20% increase in the equity day one. So the returns are listed here, and I'll go through the details in a few minutes of the exact specifics. But long story short, it's a 2.6 times your money. So what that looks like is if you put $100,000 in over the course of 5 to 7 years, you're going to get $260,000 back. And I'll break down exactly how that works a little later on. So let's move on and talk about the business plan. I'm going to hand this over to Chris because he's going to be the one that's actually implementing this business plan. So Chris, take it away.
So I've got a kind of a real quick story real quick. Sen and I have been investing for a number of years, and we started off with a triplex. I was a little timid to get into the triplex or even spend any money at all. Pulled the trigger on one, and now we're on our 11th project together, buying buildings and operating them. And during that process, during that life cycle, we worked with a couple of different property managers, and we just weren't happy with what we had out there. 2 years ago, I left my job in the IT space. I had a 6-figure job, had great rapport with the members around me, and decided to open up my own property management company and grew the business in the last 2 years from the 30 doors that we picked up just in Twin Falls, Idaho. At the end of May, we'll be over 400 doors. So we said 350 now. We actually signed a couple contracts this month. We'll be over 400 doors between Bliss and Pocatello. So we're growing very fast, but it has everything to do with how we operate, how we manage. And I believe there's a couple of owners on the call right now that I currently do property management for, and they're here because they want to see what else is going on out there. So the business plan for this property, when we first underwrote this property, we noticed rents are good. And once again, credit to the builders. They've done a great job on this property. It's going to be 100% leased up before we buy these buildings, which is fantastic for a property manager to come in and take over. Some of the things that we'll do value add. So we will work on transitioning utility billbacks. The rents are a little low, so we'll work on increasing those rents as soon as leases come available or where we can. Obviously, if they're a lease, we have to wait till that lease ends. There's options for uplifting the property in poo stations. There's options for uplifting the property by adding paid parking spaces or reserved parking spaces. And we can go into the weeds all day long on how we can add value, like adding covered parking, adding solar panels, stuff like that. But the reality is this property is ready to go, plug in day one, and we're really excited for it. So market comps in Jerome, Idaho, we've just talked about the rents were a little bit low. What we're looking at right now is Jerome is really close to Twin Falls. Twin Falls obviously is the king when it comes to rents. 3 bedrooms, you're looking between $1,600 and $2,000. Jerome's 15 minutes away, and these rents are at $1,400. Just in Jerome by themselves, we're seeing other properties marketing at $1,600 all the way up to $1,800 in rents for the 3-bedroom, two bath spaces. And these are all comparable because they're brand new builds and they're within a 10-mile radius. So we know we can get up to that $1,650 right away once those leases come available and still do utility chargebacks. Whether it's the water utilities, the lawn maintenance, anything that has to do with common areas, we can bill back to the tenants on that next lease. So we're really excited about this project. Sales comps, I don't even have to go over this. The reason why is we got the appraisal back. The appraisal back speaks for itself. We're buying the building at 5.1. It appraised for 5.48. And the market in Jerome is growing. And we're actually going to hear about that pretty soon, about what's coming into the Jerome market and what businesses are coming in and what other value adds really close to the area that we can add onto this apartment complex. Senna, did you want to talk about our relationship with Frontier and the loan terms?
Yeah, absolutely. So I love stories as well. Thank you, Chris, by the way. You did a great job on that, explaining all that. Frontier is an amazing partner of ours. This is actually our 4th loan with these guys. Funny story. 3 years ago, I just saw them on a billboard and called them up and said, "Hey, I'm interested in getting a loan with you." And they were the most amazing lender to work with. They've helped us through several different projects and continue to help us today. The lender is becoming a very good friend of mine and actually asked if he could invest into this property, which is a huge credit to the property, right? If the lender asked to invest. So let's talk about the loan specifics, right? So you can see all these things here, but the things that are really important is we have a 10-year term. Now, with all the uncertainty with the debt market and all those types of things, that 10-year term is something that's really important. If the business plan doesn't quite go with the refinance, if that doesn't work out, we're still going to be profitable through this entire time. And even if interest rates change, we're set for a solid 10 years on this property, which is absolutely phenomenal. They're also giving us 24 months interest only, which really helps us with the cash flow and stabilizing this property. And they're giving us a really good loan to value, somewhere between 75 and 80%. They haven't given us that firm commitment yet, but even at 75%, this is an amazing investment. So having a good lending partner is absolutely critical to the success of an investment like this. And then on the refinance, I've got good relationships with both Fannie Mae and Freddie Mac. I have no concern at all about doing the refinance in 2 years, as long as interest rates cooperate. If they go up over the next 2 years, we'll have to do a different plan, and I'll go over plan A and plan B here in a couple minutes with you. But the Fed has come out and said that they're going to lower the interest rates 3 times this year and 4 times next year, which bodes really well with our business plan. So let's cover the sources and uses next. This really just breaks down, where the money's coming from and where the money's going. So on the left, this is the sources. This is where all the money is coming in from. And then on the right is where it's all going to. What really matters to you is that these numbers match. And so we're raising this 1.3 million, 1,325,000 from equity partners just like you. And as I mentioned, our lenders asked to invest, our accountants investing, the property managers investing, all 3 of the partners on this call are investing money into that as well. So it's already very well capitalized. So now let's go and talk about plan A, plan B. So on the left here, this is our base case scenario. This is the plan that you should make your investment decision based on. I have no doubt that we're going to hit that. So as it says here, it's a 7-year-old with a refinance in year 2, and then sell at a projected exit cap rate in year 7, exit cap rate of 6.0. Now, cap rates, I'll explain the details of that again in a couple of minutes, but cap rates really follow interest rates. We're buying this at right about a 6.5 cap right now. And we're projecting that cap rate's going to decompress as we go further on. And then it comes out to be a 2.6 equity multiple. So the question you should be asking yourself right now is, what if that doesn't work out? I mean, that's what I would ask if I were you. So we go over to the right. And so if the interest rates don't work out the way we think, and we can't do the refinance, the plan is to do a sale at year 5. And now that will change the equity multiple and the internal rate of return. That'll come, but it still comes out to 2.26 times your money in 5 years. That's still pretty darn good, in my opinion. It is only a 19% IRR in comparison to the 25, 24 we talked about earlier, but it's still a lot better than the stock market and a lot better than any other investment that you probably are going to find out there. So plan A, plan B. All right. So now let's talk a little bit about the market. As Isaac mentioned, both Chris and I call the Twin Falls area home. This property is located in Jerome. It's literally 10 miles from my house. As you can see here on the map, it's right smack dab in the middle of several major cities between Boise, Idaho Falls, Pocatello, and Salt Lake. And those of you that are familiar with Idaho, Sun Valley is only about an hour north, right above Shoshone. So this thing is like right in the middle of everything you'd want to be. And the actual area, we'll move on to the next one, is the area that Twin Falls MSA is growing super, super fast, faster than any other part of Idaho. And Idaho is one of the fastest growing states in the nation. And you see here, the job market in the Magic Valley has increased by 5% over the last year. And the future job growth in the next 10 years is targeted to be at 50%, much faster than the US national average. We've been ranked the #1 place to live on several different lists several times. And the income in the area is great. $64,000 a year average income. And the average rent price, as you can see here, is already $1,598. So we have no issue with getting the rents that we're targeting. And I want to point out this slide here, this section on the slide where it says Jerome is 11% more cost effective than Twin Falls. Because Jerome has been in the past historically a bedroom community. People live in Jerome and then they go to work in Twin Falls. So there's so many jobs that you can pull from. And because of that, Jerome is growing super, super fast. You can see here, the bottom right, the population grew 28% over the last several years. That's a 7,000 people increase between the last census and this census. For a small town like that, it's growing very quickly. And why is that? Let's go to the next slide. We'll talk about the crime rate. The crime rate is extremely low in Jerome, right? Jerome is one of those cities where literally everybody knows everybody, and they really look out for each other. I know probably half the police force and every city council member and every county commissioner, everybody that's involved in the Chamber of Commerce, right? Like, it's just this city where people look out for each other. And as far as job growth, let's talk about the jobs. Those of you that are in Idaho, you're going to get a couple of announcements here today that I think you'll be really excited about. These are some of the major employers that are currently in the Jerome area. So, Spears is a good company. It's been there a long time. Wow Logistics. Novalex is also called Hilux Poly, Idaho Milk, Our group here is Jerome Cheese. You guys probably all know that are local anyway, that True West Beef opened up a little over a year ago. Well, they just announced that they're going to double their output of their factory, which says to me, they're going to have to double their employee count. Also, St. Luke's is building a brand new hospital in Jerome. They're still finalizing the exact location, but they've committed to build a brand new hospital right there inside Jerome. And the College of Southern Idaho, CSI, is building a huge facility in Jerome. So they're going to employ a ton of people and provide education to multiple students. And the big announcements, if you haven't heard, you can see the Amazon logo here. Amazon just announced that they're building a distribution center in Jerome. So the Magic Valley is getting our very own Amazon distribution center. That all adds up to more and more jobs, which means that there's going to be a ton more demand for units just like this in that area. All right, so let's talk about that park. This park that I told you about that is right next to this community is going to be a huge game changer for the city of Jerome. So it's in partnership with the Jerome Rec District and the College of Southern Idaho. College of Southern Idaho just announced that they're launching a collegiate soccer team, and the Jerome Soccer Complex is going to be the home field for the CSI Golden Eagle soccer team. And it's literally touching our community. The community it would be about where the letter K is on your screen. So just above the park. I know you can't see my cursor, but I'm circling it. You can't see it. Yeah, there you go. Thanks, Isaac. So this park is going to have, like it says here, two full-size soccer complexes, pathways, playgrounds, shelters, parking areas. It's going to be amazing. Now, our complex doesn't have a playground, which is, in this sense, a really good thing, because why would we take the expense and the liability to have this when there's this amazing, huge park right next door? I'm very excited about it. I will personally be spending quite a bit of time there. All right, so let's talk about the investment analysis and the specifics. Before I go, can you go back one more? I just want to show you just the site drawing, the site map here, just real quick. Just an aerial view of what it looks like. Looked really good. Again, the builder did a great job designing this. So let's dive into the numbers. Now, there's a lot of numbers here, okay? And I'm not going to read off all these numbers, and I'm not going to try to explain all of them on here. If any of you are interested, I would be happy to go do a deep dive with you, one-on-one or more detail. But there's a few things that I really want to point out. So the first one is, you can see at the very top where it says rent escalator. This is the rent increases that we're projecting. This is something that's very important. Year one, there's not going to be any rent increases. They're all in leases already. So we're not going to be able to change this much in year one. But in year two, we're going to get up to that $1,650. Now, another thing you should always look at when you're looking at an investment like this is, what is the syndicator projecting the future rents at? You can see we're only projecting a 3% rent increase, which historically over the last 10 years or so, this area has gotten a 5% rent increase on average. And that, taking out the big bumps from like COVID and things like that, it's averaged out 5%, and we're only projecting 3%. The next thing that's really important, Isaac, can you circle around the rubs in year two? We're going to be adding back a utility bill back for the water, the sewer, the trash, things like that, to pass those expenses on to the residents. You'll also notice that the electric bill is really low. And that is, again, because all of the residents pay their own electricity. So we only have to pay for the common area, things like the lighting and things for the alarm system, that type of thing. Also, our management fee is rate at only 5%. And part of that is because one of the owners owns a property management company and they're investing into this. But the other side of it is, this is going to be a very easy property to manage. So it really helps with that. Last thing I want to talk about on here is the very bottom line. It says net operating income. Now, net operating income, this is how apartment complexes like this are valued. It's all a math formula. So single family houses are based on comparative sales, and that's how you come up with the value. So if your neighbor really trashes their house, that's going to lower your resale value. If the other neighbor really takes good care of their property and it sells for a really high premium, that's going to increase your property value. Here, it's all based on math. So you can see there's a steady increase in that NOI number as we go across the bottom of this spreadsheet. That number is what we're going to use for that resale. So let's move on to the actual returns. If this is based on a $100,000 investment, so you put $100,000 in, and this is exactly, well, this is what we're projecting you're going to get back. I don't want to say it's a guarantee, but I'm pretty good at these things. As Isaac mentioned, this is my 18th deal, and I've taught over 100 people how to do this. I would say I'm pretty good at these numbers. So you guys can do the math on if you invest 50,000 divided in half, you invest 200,000, double these actual numbers. You can see in year one, we're projecting a $1,900 cash flow. I do expect we're going to blow that out of the water, but I'd rather under promise and over deliver. In year two, that jumps up to $8,000 a year. Now we're going to pay that out quarterly to you. So you're going to get approximately $2,000 every quarter. Now it also lists that refinance. Now I told you earlier, it's going to be 50 to 75%. As I've mentioned before, I like to under promise and over deliver. This does have a bigger number than that. I have absolute faith that we will hit this number that's on here as a return of capital, but I want you to bank on 50 to 75. Now, because we're doing the refinance in year two, you'll see a little bit of a lower cash flow in year 3, 4, 5. Now, the reason for that is because we will have a bigger loan payment, but you have to remember, you're only going to have, say, 25% of your money in here. You can have a $5,000 to $25,000 investment, and it's going to be kicking off $6,000 in cash every year. So that comes up to that net return that you see on the bottom, 25% IRR and 2.68 equity multiple. All right. So a couple of you on here I know are really concerned about taxes. So let's talk about depreciation. So every time we buy one of these communities, we do what's called a cost segregation. And because of a cost segregation, we're able to accelerate the depreciation. Now, normal depreciation on a residential complex like this is done over a 27.5-year period. Basic math, you take the purchase price of the buildings, subtract out the land, divide that by 27.5 years, and you get to write that off on the taxes. Well, there's a thing called a cost segregation where we can break up all the different components of the building. And now we can write those off in 5, 7, and 15-year buckets. That makes it just come to you a lot faster. Now, there's another real good perk called accelerated depreciation, where you can take 60% of that 5, 7, and 15-year bucket and use that all in year one. And so, long story short, when you get your K-1, which is your tax document, it's kind of like a W-2 or a 1099, but it's for partnerships or LLCs. When you get that at the end of the year, you're going to see a 55% loss, paper loss on that document. So if you invested $100,000, you're going to see $55,000 of depreciation that you can use to offset some of your other income. Now, you guys, I'm not a CPA, and I'm definitely not your CPA. And there are some rules and caveats on how to use this. So be sure and talk to your tax professional about how this impacts your specific situation. But worst case scenario, the income that comes from this is going to be tax deferred because of this depreciation. It's a great perk. All right, let's just move on. We'll talk a little bit about fees. Of course, there's lots of expenses that we had to pay up front to get into this opportunity. So we are going to take a couple of fees, asset management fee, 1% acquisition fee for putting the deal together. And then, of course, we'll also take a fee when we go to sell it. I already talked about the property management fee of 5%. And we don't have any construction projects planned, but we do have the ability to take a 5% construction management fee. But as I mentioned, we don't have anything planned. All right, let's see. I'm going to hand it over to Isaac to talk about the next steps, how to actually get started with this.
Yeah. So as you can see here, there's a timeline for the investment. We've already started the due diligence phase and the capital raise for the property. And obviously today is the investor webinar. So the main dates you'll want to be focused on are right there, the April 10th and the May 1st, which is the date your investment funds are due and the projected close date of the property. So keep an eye on that. April 10th is the main date. And so, as far as what you can expect from us, as we go on, we will be sending out quarterly reports via email, letting you know how the business is progressing, as well as important financial reports that you'll want to know and keep track of. The property will also, like we said, be profitable day one. So, you should expect your first distribution to come after the second full quarter. But we're obviously going to be shooting for that to come as soon as possible. As the general partners, Senate, Chris and I, we want you guys to have all of your questions answered. And so for you, we also want you guys to feel confident throughout the entire process. So if there's any questions that you guys have, anything you don't understand, anything you need clarification on, please send us an email, or especially on as we send out the updates and the information, et cetera. Let us know if you have any questions, because we want you guys to be completely informed.
And we will be happy answering questions that are coming to the chat here in a couple of minutes. We're just finishing up
Yep.
with it, and then we'll have those questions addressed.
Yep. So who is eligible to invest? Well, this offering is specifically for, we're actually only legally able to accept accredited investors. And so you can invest through cash transfer, IRA, 401k, et cetera. Multiple avenues you can invest. We do have that minimum investment requirement of 50,000. But as time goes on and spots will run out, like Senate said, we already have a lot of spots reserved already for commitments. We're going to be giving those spots priority to those higher commitments. So our total raise is $1.2 million. And like I said, we've already raised some from those commitments. And if you really want to take advantage of this, you'll need to act quickly. And like I said in the last slide, the last day to invest is April 10th. You can see here that these are the steps. We'll be sending out more details in emails and the follow-up email with the slide, the OM, as well as the recording if you want to go back through. All right. Thank you guys so much. For those of you who are ready to secure your spot, I will put the link in the chat, or actually Senate already did. Thank you, Senate. For that link, that's the link to the portal that you can go through and set that up. We'll now take about 15 minutes or so to answer any questions you might have. So if you haven't already, I know we have some thrown in the chat. Please do them now, and we'll go through and answer those. Some of the questions that were already answered, if you haven't seen that, is the acreage of the park and when will it be completed. The acreage of the actual park is about 17 to 20 acres. And the coach said that it's expected to be about fall of 2024, but up to a year. So somewhere around there is when it will be completed. And the appraisal was conducted by the finance company agent. So they have all that information already. So it's going to be a perfect seamless transition for the financing. And then the last question that was answered was the projected reserves from day one are going to be roughly 63,000 to cover all those basic things and what ifs for the safety net.
So I think we'll take the rest of the questions in order as they came in. I didn't answer some of the questions just because we wanted them out here with everyone, so that if there were any additional questions on that question, we can answer them. But first and foremost, what allows the rents to raise to 250 in 1 year? What impact will it have on current renters who are taking advantage of below market rents, and how will it impact occupancy? We all know if we increase rents, some people may not want to stay. That's on the property manager to figure that out, and I'm happy to take on that task. When we do an evaluation for market rents, we take into account comps for other complexes within 10 miles and the ability to keep it occupied. If you look at my history of keeping places occupied at market rent, once again, happy to have that conversation on the side, or if you're one of my current owners, we do a very good job of keeping places occupied, especially when it's market value, especially by understanding those markets. And once again, I manage from Bliss all the way over to Pocatello. So we're very much plugged into what the markets are in Wendell, Jerome, Gooding, Shoshone, Twin Falls, et cetera. And to be perfectly honest, the rents at this complex are undervalued. So if we increase it 250 and we tell tenants they're going to pay utilities, will some of them leave? Yep, they will. But that doesn't mean we won't be able to fill those spots. That simply means that we'll have a little bit of churn when those leases come up. And the beautiful part about it is when those leases come up, they're staggered as the buildings were completed. And when we renew those leases, we'll actually push for those leases to end more in the summer, spring, and fall versus the winter, That way we can maximize the market rates that come in, because in the winter, it's really hard to get market rate rents. Whereas in the spring, summer, and fall, it's a lot easier, especially in the summertime, because we know families like to move around when school's not in sessions and not to interrupt the children when they're at school. So
I
that's
think
how, go ahead.
I was just going to say another point to add to that is as we're raising those rents 250 to the market rent, it's not like we're raising them way above. We're raising them to the market rent. So everyone else is going to be renting around the same price. So if they have the option to stay put, stay in their home for the same price or go somewhere else, more than likely they're going to want to stay. So
Yeah, nobody likes to move. And here's another one for the team. In the sellerly scenario, you described a market where a complex cannot be refinanced by the market, but the market is extremely favorable. How do you run a true downside scenario where you can't refinance and the market's not strong?
So I'll take that one, Chris, if you don't mind. The answer to that is we're targeting a 7-year business plan. And if we can't refinance, we're gonna start looking at a sale at year 5, but it could go all the way out to that 7-year. And I actually have got that spreadsheet I showed you earlier, and I have it live in front of me right now. If the market is the same as it is today, so we sell it at the same cap rate we're buying it at today, without a refinance, it still comes out to, that 2.3 number as far as the actual equity multiple to you. And if it decompresses, so the value goes down, which I do not believe that's going to happen, but it is possible, right? And it decompresses to what they call a 7%. Now it's still only 2.19 times your money. So it's still more than doubling your money. So could that happen? Yes. But I think that I'm confident that the scenarios that we showed you here are the most likely scenarios, plan A and plan B.
Right.
Let's see what's next.
So Isaac, can you take us back to the capital screen? We were talking about the $100,000. Victor had a question on how does the capital drop from 100,000 to 6,000 in year 3?
I can answer that as well. So it's because of the refinance. So the capital that you actually have in the deal, what it shows is 5 in year 2, year 1 and 2, you're at 100,000. So it's right below the 1 and 2, Isaac, the top row on that. So if you invest $100,000, you're going to have, that's how much the capital you have invested in the deal. Now, I told you earlier, I want you to plan on 50 to 75% on the refinance, but more than likely, based on our projections, we're actually going to get back 95% of your money. So with that refinance scenario, you would only have $5,000 left invested in it. So you can see that on the top row right under year 3. Again, I want to underpromise and I want to overdeliver. So I want you to expect between 50 and 75 on that refinance. But to be accurate on this, it does show the 95%.
Victor had another question. What do the returns look like for the management group with that 30-70 split?
Well, first thing I want to say about that is the amount of money that we're making shouldn't really matter a whole lot to you as long as you make what you're happy with. Okay. And I've had that theory for a long time. I want to take care of the investors first. And then what I make on top of that is, a bonus, right? So we make sure that these returns are good for you. And then we take care of ourselves on the back end after that. Now, I do have the answer. I wasn't trying to avoid the answer. I do have it right here on the screen. So we make the majority of our money at the sale, at the exit. So in year 7. So we're going to make a total of $1,496,884. And again, the majority of that comes at the sale.
And that's with us performing. If we don't perform, we really don't make anything.
Yeah.
So we're taking a 7-year commitment to make sure we operate the correct way. And if we operate and make you money, that's when we make money. The reality is if we don't make you any money, we're not going to make anything.
Yeah, absolutely. Take care of the investors first. You guys always come first. That's why we put that preferred return in there to make sure that you're taken care of.
So Victor had another question about the fees. Isaac, can you move us to those fee schedules where they have the asset management and acquisition fee and whatnot? He wanted to know which one of those fees are one time and which are annual. And that's actually a really good question.
It is a good question. So the first one, the asset management fee, that's an annual fee. And as it says, it'll be paid out monthly, but only if the building is profitable. If for some reason it's not profitable, we don't take that management fee. The acquisition fee is one time based on the purchase price. So you take the 5.1 million, times it by 2%, and it comes out to $102,000 one time. And that pays us for all the work we put into it, that type of thing. Refinance capital transaction fee and disposition fee, those are one time when those things happen. So for all the work it takes to sell the property, or for all the work it takes to refinance it, we get paid on that. The property management fee, that is ongoing. So that is to pay Chris's team to manage the property on a monthly basis. And that will be reflected on the monthly basis. And the construction management fee, if we had a construction project, would be on a project by project basis. But again, we're not going to have we don't have any projects that are actually put out there that are planned. Well, hold on.
We don't have any plans, but we have some proposals. Like if we need to do boundary fences around some of the units to protect us from other owners. And what my job is going to be on that, and why there's a construction management fee, is I have to go meet with these owners. I have to negotiate if they're going to pay 50% of that, where we're going to put it, what vendors we're going to use, et cetera. So from a property management perspective, that 5% covers our time outside of managing the property to go on site, to meet with vendors, et cetera, to make sure those projects happen. Another one would be, we're talking about putting in dog poo stations where tenants have dog bags and a facility to throw them away in, so that we don't have dog poo on the grass and someone's stepping in it or kids are playing. We don't have to worry about that. Small things like that we're looking at doing, but we haven't finalized anything. We just want to make sure everything's going okay before we kick that.
Great.
Todd had a question. Since this looks profitable already, why is the current owner builder wanting to sell, and how did this come about?
Well, so I'm going to answer it backwards. So how did it come about? Reputation is something that's very important to me. And I work very hard to make sure that people know what I do and who I am. And so the builder actually reached out to me and said, "Are you interested in this property?" Now, their reason for selling, I asked them that very clearly. This was always their business plan, right? They built this property to sell it. And so they made a good return based on the building and building the building, and they made their income off of it. Now, that said, they're interested in possibly reinvesting some of that profit back into this building. So their business plan was always to sell it, never to operate it.
Okay. And Victor has two questions, but I'm going to put them together just because they fit very nicely together. If you're oversubscribed, how do you allocate the amount to invest? And if you're undersubscribed, although unlikely, do you have funds to close?
So yes, we have the funds to close if needed. That's all been taken care of. We have a contingency plan. I do think that is unlikely, as you mentioned. We will be able to raise the money to be able to close without an issue. If we're oversubscribed, how are we going to allocate that? Well, there's a couple of different ways. So as Isaac mentioned, we are going to give priority to the larger investors first. And if we do get way oversubscribed, then what we'll do is we'll figure out the amounts that were oversubscribed, and we will return money back to the investors based on that percentage.
Okay. And Carrie had a question. Why is Jerome a good place to raise a family?
Well, I raised my family there. I lived there for, how long did I live there? 15 years. I went to high school in Jerome. I finished that there. It's a good place to raise a family because the schools are really good. As I mentioned earlier, everybody knows everybody and they take care of the kids. There's tons of things for kids to do, amazing activities, very low crime rate, good schools, but they're great. Good sports teams. People go to football games. There's now a soccer complex for high school soccer. It's a great place for families.
Victor wanted to kind of compound on the conversation around reserves and what we have for reserves on the property, which is $63,000. He wanted to make sure that's the proper level we have for reserves. And the reality is, yes, that is. Sen and I have been through a program on how to purchase and manage multifamily, which we took, I think, 3 years ago when we first started our journey into the multifamily space. And this is the reserves that we use on some of our properties. Some of our properties actually have lower reserves just because they're performing well and their markets are good. But we like to start out with a standard reserve, and this reserve is the correct percentage for this property.
Next question we have is what recreational activities are there in Southern Idaho?
Chris, you want to take that one or you want me to?
Most of the people on the call live in the Magic Valley. We're surrounded by mountains. We live in a valley. We're in a desert. So you have, the mountainous areas, the hills. You have anything recreational in the sense of motorcycles and what are they? The new turbocharged SUVs that they have that are, what are those called? I don't own one because we don't, what was that? ATVs, side by sides. I know there's horses, golfing, there's the Snake River, which is within 15 minutes of this property. There's a lot to do. Sports wise, a lot of it's associated with the schools and the rec departments, but there's softball tournaments that get put on. There's the new one's pickleball. There's so much excitement around pickleball. It's crazy. I mean, I was talking with my CPA today about how much traction there is about pickleball. I never even heard of this thing until, this year. So there's quite a bit to do in Southern Idaho when it comes to outdoor stuff. And having that soccer complex so close, 20 acres for your kid to go play out, it's amazing.
The other thing, Chris, you kind of touched on this, but I want to add to that if that's okay. If you think about back to that slide on the map where we're really close to Boise, we're really close to Sun Valley, we're really close to Salt Lake. This is such a central area. There's mountains all around us. Within an hour drive, you can be on one of 6 ski resorts, hiking, as Chris mentioned, ATVs, side-by-sides, camping, fishing. If you like gambling, Jackpot, Nevada is 45 minutes away. The Magic Valley really has everything you need, and most of what you want, but you've got Boise, an hour and a half away, and Salt Lake City, 3 hours away. So anything you want is really close.
Got another question here. What is the most a person can invest?
There is a number. The banks don't like it when the investors get too big. Let me give you the exact number. $347,936.96. That comes out to roughly 19% of the amount that we are targeting. So we've got to keep you well under the 20% total ownership.
Next question was, who was the builder?
Their company is A&W Properties. They, as I mentioned, these guys, they've done a great job. They've built multiple communities in the area, and they've done an amazing job. I'm glad to partner with them.
Is the property close to schools and shopping? Kind of already answered this a little bit, but.
Yeah, there's a Walmart roughly
Mile and a half.
It's a mile and a half. I was going to say a mile. There's a Wrigley's grocery store, half a mile, quarter mile away, probably. Schools, there's 2 schools that are within a half a mile of each other. The high school is less than an hour or less than a mile away. So yeah, really close to shopping and schools.
As you evaluated the opportunity, what downsides or concerns did we address?
So the biggest potential downside for this is the seller's market, the ability to sell it at the end. So there's not a lot of maintenance or construction downside. We don't have to worry about repairs or anything like that. We covered that. There's not a lot of economic risk. Idaho is extremely business friendly. And I don't believe that there's a lot of rental risk, actual people renting it or the rents going down because of all of those jobs and everything that are flooding into the market. So the only 2 real risks are, it all circles around interest rates. So whether or not we can refinance it or not, and whether the cap rate is going to expand or contract. And that cap rate I talked about earlier is how these properties are valued. It does follow commercial interest rates. So if the interest rates go up, that will be a little bit of a problem. But as we demonstrated earlier, even the worst case scenario is still pretty good.
Well, Senator, we haven't even talked about the other way to exit. These are fourplexes. And if we can't find a buyer to buy at 28 units, we can subdivide the lands and do an HOA for the common area space and sell them off in singles. So you have 7 buyers instead of 1 buyer.
Oh yeah, that's a great point. It's another
scenario.
That's another awesome thing the builder did. Every single one of them they all have separate power meters, as we mentioned, but every building has a separate water meter. That could absolutely be done. Yeah.
Yeah. So the next question is, in the year you raise rents, what overall occupancy rate do you project to reflect renters that may balk at increasing?
The reality is there's 1 rental that's a 3-bedroom, 2-bath in this space available right now today. There's 2 others that are listed, but they're not move-in ready right now. So that shows you the market is ripe for that increase. There's not enough inventory in Jerome, Idaho for a 3-bedroom, 2-bath. And there's nothing like it in that size. In a year from now, with what we're seeing from a building perspective, will there be some more? There will be some more, but we'll be primed for that. We'll be right in the sweet spot. We'll have the good price. and will have the huge 3-bedroom, 2-bath with the washer and dryer hookups, with AC, with furnaces that are for each unit. So their thermostat controls an AC unit, controls a furnace. They get to adjust all of that themselves. It's right for what we're looking for in this property. And that's why we like this property.
Well, that, and also as the more developments happen, also the jobs are increasing as well, right along with that. So it's a common line. Next question is, I imagine your comps are hardly as new, supporting rent increases and people staying still.
So some of the comps we use were for complexes that are opening up in the next 1 to 6 months. And they've listed and started to get individuals to sign contracts and move in. And that's exactly what the owners did for this property, is they started to lease up the units before they were finished. There's just such a high demand for rentals in the Magic Valley. There's nothing out there. If you go on and you go to Zillow, start looking for 1 bedrooms, 2 bedrooms, 3 bedrooms, they're either not new and not nice, or they're very expensive. And I feel like we've got the sweet spot on this one.
Yeah, I think another huge factor, I don't know if you mentioned it very much, is how big the 3 bedrooms are. Like they're massive rooms, way larger than any other place around. So
one of the other active comps for 3 bedrooms is 900 square feet. So we're adding 400 square feet of space for these units that people can take advantage of. Some 3 bedrooms won't have AC, or they'll have centralized HVAC systems. They won't be brand new. They won't have amenities like the property's plumbed for fiber already. The property already has cameras installed for security. The property has a brand new parking lot. A lot of these older apartment complexes don't have those amenities. People look for, hey, I want a washer and dryer in my unit. I don't want to have to go to a community laundry space. Once again, that's why this property is a great performing property.
yeah. Next question we have is, what about an 8%? I'm assuming that's when you're talking about up to a 7% cap rate. What happens if it goes to 8? I'm assuming that's what that question's asking.
I have that. Give me just a second. Pull up the underwriting. Okay, so worst case scenario. So first let me just say I don't believe that's feasible. But even if that happens, we can't refinance it, and we sell it an 8 cap rate in year 5. I'm sorry, excuse me, in year 7. We sell it an 8 cap rate in year 7. It's still 2.05 times your money. So $100,000 investment would get $205,000 back. Good.
You still 2x it.
Yeah, I really don't think that's realistic. I think it's going to be better than that, but I guess you could use that as worst case scenario. This complex, it's going to increase in value, not decrease in value. So
yeah. Another question, do all investors get refinanced, GPs and LPs?
Yeah. So the way the refinance works is we'll first pay back any preferred return that hasn't been paid. So remember, I told you earlier that the investors, you guys, will get the very first 6%. So if for some reason we don't make that during it, because you can see here, thanks for going to that, Isaac. In year 1, we're only going to be able to pay out a roughly 2%, which means we're going to owe you another 4%. Okay, so the first thing is we'll pay that off very first. And then after that happens, then yes, the LPs get refinanced first, and then the GPs get refinanced after that.
Yeah. How much is the management team investing?
Oh, I've got to do the math. So somewhere between 150,000 and 225. I'd have to actually sit down and pencil that out, but between 150 and 225.
And there are some contingencies in there. If the management team needs to reel back, say each of us are committed 75,000, we need to reel some of that back to let someone have the advantage to come in. At the minimum we're putting in is going to be, I believe, 50,000 a piece. But there's always room for us to put more in should we need to.
How does the 20% expense ratio compare to other properties in the area?
So admittedly, it is lower. The average expense ratio for other properties in this area is between, say, 28 and 32%. But as we've mentioned several times, this is a brand new build. So we're going to have a lot lower maintenance cost, a lot lower repair cost. And we were able to negotiate down the management fee. Instead of typically we pay 7 to 8%, we're only paying 5%. And we're getting a slam dunk insurance rate on this property. So that really helps us lower that down to that 20%.
Yeah. Is there a warranty on the building? Another person asked.
No, we did not. We chose not to buy the warranty We did inspections on multiple different stages through the property. And as I've mentioned several times, the builder did an amazing job. I didn't figure that we needed that.
What is the right refinance percentage calculated to be in year 2? I think we might have already covered that a little bit.
So remember, I want you to use the 50 to 75, but we'll probably outperform that to be in the 90 to 95. Or hold on, it's tough to answer questions via chat sometimes because he could also mean what's the interest rate we're using to do the refinance.
Yeah, that's what the question is.
Yeah. So if it's the interest rate, I'm targeting a 6% interest rate for agency debt, which we would be at a 6.6% if we did it today. And remember, I'm projecting interest rates to go down. The Fed said they're going to do it 3 times this year and 4 times next year. So we should be able to hit 6%.
Big conversation around multifamily today is excess supply in the market. Because of that, tenant retention. Do you see that to be an issue? Not in the Magic Valley. We're 10 years behind.
Big conversation.
Sorry,
how long is this open? No, you're good. You're good. Okay. How long is this open for? And what is the lowest you can start investing with? Could you continue to invest over the years? Lowest is 50,000, and it's open for starting. I believe I'll pull up the slide here. The funding deadline is April 10th. So we have up until the 10th to get funding in and continue to invest over the years. I believe that's no, correct me if I'm wrong, but that's the deadline there. And
yeah, we'll have more investment opportunities in the future, but yeah, this one, you've got to get it in. We're going to get it in by that April 10th.
Same person that asked about the warranty said builder warranty. So I'm guessing that's the same question.
Yeah, Keone, we talked with the builder. They're not providing a warranty on the space as it sits right now. But my opinion, the warranty is reflected in their being at this meeting, checking out the webinar and potentially investing. That's the quality of work they're going to put in that they want to even consider that. So Senate and I have been on site. Isaac has been on site several times, and we're happy with the work that they've done. We're happy with the appraisal and inspection that's been done. So will there be kinks? Probably. There's always a kink somewhere where something breaks, and we'll just hit that in stride. We anticipate, just because of the quality that we've seen in this work, that there's not going to be a lot. It's a good product.
Yeah. Last question I see here is, what is the DSCR in year 1 and in the refinance?
I got that right here. DSCR in year 1 is 1.9%. And after the refinance, it is 1.38%. Yeah, it won't show on that. It's further down. So yeah, 1.9 and 1.38.
Awesome. Doesn't look like there's any more questions. Once again, we'll be sending out this recording of the webinar along with the link to invest. So you can go back through and check out questions that we've had. And if you guys have any questions that are specific to maybe your personal situation, please feel free to reach out to us and we'd be happy to answer those. Yeah. And we just want to thank you so much for being here and joining us. We hope you all have a great rest of your evening.
Thank you, everyone.
Thanks, everyone.